This is Michael Nix, your Chief Investment Officer for Verity Investment Partners. I'm excited to continue our periodic video series providing insights on market and economic conditions that are impacting today's investors. Excited to be joined by Sonders, who likely needs no introduction to many of us, but serves as the Chief Investment Strategist for Charles Schwab. Thank you so much for sharing your time and your insights with us today.
Oh, thanks, Michael. Great to be here. Thanks for having me.
So obviously a lot of things that we could talk about, but I would really love to start on kind of the macro level, kind of big picture. And as we think about kind of today's economic environment, investors have experienced heightened inflation, a Fed rate hike cycle, heightened geopolitical risk. The list goes on. And seemingly the market and the economy has really just climbed this wall of worry. And you have shared a concept or framework around rolling recessions within the economy. Do you mind talking about that a little bit and then just kind of bringing that to current day and where you see things as we look forward?
Sure. So thanks, Michael. The normal economic expansion, to the extent there is a normal one, or economic cycle, I should say, is somewhat linear and tends to occur in the aggregate. So whatever the cause of a recession is, often a credit crunch or overly tight monetary policy that brings on a recession. Then you come in the recovery phase out of that, the expansion phase, then you go into late cycle tendencies, and then the next recession. And it tends to happen in the aggregate. Since the pandemic, it's been anything but linear. And what we've had, and not to rehash that pandemic period, but just to frame it from that point, when everything was locked down during the early part of the pandemic, the only part of the economy that was humming was the manufacturing side of the economy because the goods access was still there. Services was completely shut down.
Right.
So we had this boom in manufacturing when services was in a recession. Then you had the opening up, courtesy of the vaccines, services ramped up, but manufacturing went into a multi-year recession, arguably only pulling itself out of about 7 months ago.
Right.
And now we've got services rolling over a little bit. So we've had this roll through different segments of the economy impacted at different times. And I think that's the most likely scenario that is going to continue, barring some sort of black swan or major credit crunch event or a true spike in inflation that caused the Fed to have to really ramp up policy. Absent that, I think the roll through both expansions and recessions could be the name of the game.
So that'll continue as we look forward. So, Lizanne, there's been this discussion around this framework for this K-shaped economy, where you kind of have the haves and the have-nots and the divergence of those. Is that something that you subscribe to? Are you looking at that in terms of, is there a time frame where that starts to erode in support of the economy?
So yeah, I think it's the economy is still brought to you by the letter K in my mind, and it's most often the reference is to high income consumers versus low income consumers. That persists. I think what could start a convergence there, and this is not my base case, nor is it probably a case anybody would be looking for, would be some sort of serious dislocation in the market, which in turn impacted the high end more so than the low end. But you've got K's in a lot of different places. You see it in the capital spending side of the economy with anything AI related still in boom territory, non-AI related quite a bit more subdued. You see it in inflation statistics, whether it's goods versus services, whether it's discretionary items versus non-discretionary items. So there's a long list of where you could use the K as a descriptor. And again, we have some possibility of convergence, but I don't think we erase that as an apt way to visually think about this economy, probably until the next cycle, however that's defined.
Gotcha. Yeah, fair enough. So bringing it down one level and just really looking at the market, love to discuss kind of your outlook for earnings. We have experienced and obviously very strong earnings growth, unprecedented in many ways. How are you thinking about the earnings growth projections over the next year or two? And do you think the market will meet those expectations?
So right now, the consensus, what they call the blended growth rate, which is the combination of the companies that have already reported, now we're talking about second quarter reporting season, plus the consensus estimates for those yet to report. We're up to about a 26% expected growth rate for the
Yeah.
second quarter. That would be a follow-on to a very strong plus 20% quarter in the first quarter. In both cases, handily beating expectations. But I think what may be something to be more mindful of in the current backdrop, and not just this reporting season, but probably in the next couple of reporting seasons, is not just the amount by which companies beat what you should think of as the sell side consensus. That's analysts who cover the stocks, they publish their estimates.
Right.
That's where the consensus number comes from. But there's increasingly a focus on the buy side expectations. So
Mhm.
portfolio managers, fund managers, almost we almost used to think of it as the whisper number.
Right.
And there's often a big spread, particularly in the tech adjacent AI space, between that sell side consensus and buy side expectations. And to me, a key to whether we're really starting to build some angst about those forward expectations is how the stocks react if their results fall somewhere in the middle. And a
Right.
poster child of that in this recent period, though not a US company, was Samsung. Handily beat the consensus sell side, underperformed the buy side expectation, and the stock got creamed.
Right.
So that just would be a way to maybe quantifiably measure heightened sensitivity to whether the expectations bar, the whisper number, the hope and the hype has been set artificially too high, even if so I'm confident that we'll continue to see a beat of that sell side consensus, but that doesn't necessarily mean it's smooth sailing for how the individual stocks react in the aftermath of those earnings.
Yeah, I mean, I've always believed that, you typically see estimates come down through the course of the year. And as
Right.
I look out to 2027, 2028, even, you're still have this expectation of double digit earnings growth. It's just, what do we believe is the potential for the market to achieve that long term?
Right.
And so,
And by the way, if you look at various zones of earnings growth, the worst zone for earnings growth historically has been recession type depression in earnings,
mhm,
earnings that are between, negative 10%, negative 20%. But the best zone for the market in terms of how the market performs on an annualized basis is actually the zone just above that, which is still in negative territory. It's
yeah,
that recovery zone. The second worst zone is actually earnings above 20%,
yeah,
where that's had, barely positive returns. And that's because the stock market is a forward-looking mechanism and it
right.
tends to start to think, okay, earnings have stopped getting better, they're about to get worse. And even in an absolute sense, at a snapshot in time, earnings are still strong. It's that deceleration that can sometimes cause problems in the market. We're seeing that a little bit at the individual stock and industry level, but certainly not in the aggregate, at least not yet.
Yeah, in that vein, and we often talk about, are we pulling future performance forward,
Right.
and we're going to have a prolonged environment of below trend returns as the market just catches up from a valuation perspective. So it's kind of how we think about it.
Yeah.
So kind of diving a little bit deeper into that earnings picture, are there any sectors that you think that the market's being overly optimistic or even overly pessimistic at this point, or just trying to settle things out?
Um, you know, I don't know that there's any significant outliers. In the again, the tech and tech adjacent area, I think the consensus estimates are probably still fairly reasonable. It's just,
Mhm.
is there too much hype
Right.
that's a bar much higher? There's it's sort of a combination of not so much just earnings expectations that have gotten too low, but combined with just the nature of this market lately, which is unbelievably rapid fire rotations at the sector level, at the subsector level. And some of it is sentiment driven, positioning driven, valuation driven. We do have ratings on sectors, and we have favorable ratings on healthcare, on industrials, on materials, and on communication services. That said, I think this is a very tricky environment to make monolithic sector recommendations. I think the
Right.
half-life of these regime changes and narrative changes that can cause sector movements to turn on a dime and subsector movers to turn on a dime suggests that I think there's two things you can do in that kind of environment, as opposed to trying to anticipate what the next shiny new object is going to
Right.
be for the next week or two at a sector level, is we believe in factor-based investing. So looking for a certain set of characteristics, but also think that rebalancing strategies can be beneficial in that you take advantage of more churn and higher dispersion and lower correlations and just stay in gear by, maybe adding and trimming a little more frequently. And so that's been maybe a more subtle way to bring in a traditional discipline versus just these, overweight the tech sector. I just
Right.
don't think those monolithic calls are the way to go in this market backdrop.
Yeah. And that's, kind of plays into this sense that, maybe this is a more favorable market for the active manager, the active investor
Yep.
versus passive. And, which kind of leads into my next question. And, really, I think a concern on the forefront of many of investors that we talk to, mind is really the small number of companies that make up the larger component of these
Right.
benchmarks and whether they're kind of, masking poor health of the underlying market or not. And so you kind of related to this in terms of rotation seems to be happening much quicker. But, what's the condition that, you see a more broadening and maybe prolonged, leadership shift and from that perspective?
Yeah, I actually think it's ongoing. It's a feature of this year, with the exception of a relatively short period of time. Equal weight S&P is outperforming the cap weight S&P. The Russell 2000 is pretty handily outperforming both the cap weighted S&P and the equal weighted S&P. Small cap value from a Russell index perspective has been performing quite well. So there are opportunities to take advantage of this broadening out that may not be always reflected in traditional breadth indicators like percentage of stocks trading above, 50-day or 200-day moving
Right.
average. But one more simple way that I think resonates with a lot of individual investors who are not tracking AD lines and moving average lines is in the last year, only about 10% of stocks within the S&P have outperformed the index itself. But over the recent rolling 1 month periods, that's been bouncing around 60%. So that's one in kind of layways way to think about improving breadth. The one thing I would say is if when moving outside of the cap weighted indexes, if you're looking at smaller cap stocks in an index like the Russell 2000, which again is handily outperforming the S&P. Last year, to just put numbers on it, last year, the non-profitable component of the Russell 2000 was up 20%. The profitable component was up 10. Now, the
Yeah.
non-profitable component is 40% of the Russell because Russell doesn't use a profitability filter. So this is more of a hack than it is a recommendation. I don't
Yeah.
recommend indexes, but the S&P 600, which isn't as used as a benchmark as much for small caps, S&P uses a profitability filter, and that's even beating the Russell 2000. So I think there are opportunities away from what had been this concentration, and maybe that's an easier sell now because whether it's the Mag 7 as a cohort or the semiconductors or prior to that, the software, it has not been smooth sailing. You've had
Right.
these drawdowns that I think reinforce the notion that there's opportunities elsewhere and that we don't have to be beholden to these prior darlings at the cohort level.
Yeah, for sure. Well, kind of in that same vein, without question, one of the most significant drivers, both I think from a positive and negative sentiment, depending on the segment of the market you're in, has been the influence of artificial intelligence.
Yeah.
And AI is really becoming the defining investment theme of the decade. So, from your perspective as strategist, how do you distinguish between really transformational technology and speculative enthusiasm? And at what point does one control the other in a sense?
Well, I think that there's always a bit of both in any kind of major transformational technology. And
Right.
I very much think that AI is that, but that doesn't mean you don't get to a level of froth and hype where you have to reset the clock a little bit. What I do think is maybe an important differentiator relative to the late 1990s dot-com bubble was in that environment, it was a build it and they will come backdrop. So all the telecom infrastructure build out was driven
Right.
by forward expectations for demand, not current period demand. That is not the case this time. We actually still have more demand than there is supply. I think what we're starting to come up against is concerns about the return on investment, concerns about the ability to continue to spend, given at times supply chain problems and shortages, not to mention the inflationary impact of this AI build out and the fact that enterprises are now stepping back and making assessments as to whether the build out cost as a user of AI is worth it. At what point are we able to actually quantify the productivity statistics? So I'm wildly optimistic. I think this is
Yeah.
an AI boom, but I think there may be, if there is a bubble, and it ties back to what we first talked about, Michael, which is it may just be that the expectations bar gets set a little bit too high, or there isn't a grasping of the notion of demand destruction that happens when prices go so high and or availability starts to get constrained. The last thing I'd say is, increasing concern about the move toward debt financing, given that a lot of the spend exceeds cash flows. That's something to be mindful of. So far, you're not seeing any kind of blowout in credit spreads, but it's something to keep an eye on,
Right.
given the burgeoning concerns about whether that is the beginning of some sort of accident waiting to happen.
Right. And so you just, you shared kind of the parallel, if you would, or the comparison of the 90s in terms of anticipated demand versus actual demand. Are there any other parallels that, as you think about this market, that you're looking at that period to say, hey, these are some things that are favorable or maybe that we should be concerned about?
Well, favorable would be that we've actually seen a bit of valuation compression in many of these leadership areas, in some cases because some of the recent drawdowns that we've seen, like in the semis, but for the most part, a bit of valuation compression by virtue of the E growing faster than the P.
Right.
So the bubble back in the late 90s was a P bubble. It was a price bubble because in many cases the leadership stocks had no earnings, and
Right.
with the benefit of hindsight, we know had no prospects for having earnings. So I see that as a positive. I do worry a little bit, and there's not many examples of this, but I think was it Allbirds recently that pivoted
Yes.
from making
Yeah.
sneakers to being an AI company?
Yes.
That kind of stuff, you
Yeah.
know, generates a little bit of, oh no,
A
come
little
on,
anxiety.
really?
Yeah.
Yeah, so that's maybe something to just put on the whiteboard off to the left. But an increase in that, silly season coming back. I don't think
Yeah.
we're quite there yet, but that's something to keep
Nothing to,
an eye
yeah.
on. Because even these transformational technologies, which the internet was, it still is and has been a transformational. That doesn't mean you don't have to go through a major reset from a valuation or a sentiment standpoint. I
Right.
don't think we're there yet, but and by the way, it's not a bad thing to have these corrective phases happen via a process of rotation.
Yeah.
The average NASDAQ member has had more than a 40% drawdown this year versus an index that's up 13% year to date.
Yeah.
So it's just happened through churn and rotation. I think
Yeah.
most investors would choose that kind of corrective process as opposed to, the NASDAQ dropping by 40% all at once.
Yeah, for sure. So you referenced this earlier, and as we think about that, period as well, the late 90s and early 2000s, is there anything out there that you're thinking about in terms of what could derail the bull market? What's that black swan potential that, hey, that's something that I'm just keeping in my kind of hindsight?
Well, by definition, if it's a black swan, we don't know what that is.
Right.
Maybe the gray swan would be a 1970s type of environment where, there's a lot of charts that have gone out there sort of mapping the current inflation cycle going back to the early part of the pandemic into the spike in 2022 and then the rolling back up over and then the move back up again and tracking it against the period in the 1970s, suggesting even if it continues to rhyme, we've got another big move up. Were that to happen and not just touching up against, 3.5%
Right.
on core headline, but really back up to thinking about the 2022 peak and, with a 9 handle on the consumer price index and what that would mean for the Fed's reaction function. I do not think that scenario is priced into the market. So a known potential
Yeah.
would be that to me is the most obvious one, is a Fed that really has to kind of slam on the brakes. Even if it's more on the headline inflation side, they might have to do that just to temper demand to help bring down, even if it's energy price and commodity price inflation, which directly the Fed can't bring those prices down, but they can bring on an economic contraction in order to have the demand side
Right.
work.
Yeah, certainly agree with you from that perspective. So narrowing the focus a little bit, you talked about some different styles or segments of the market. We are focused on dividend growth companies. If you look at the last number of years, most investors have been focused on really, high growth companies, not necessarily dividend growth companies. How are you thinking about the environment today for those high quality dividend growth companies as we look for investors who are thinking about income and income growth?
I think that's a pretty ripe area of the market from an opportunity standpoint. Some of it is just simply driven by rotations happening and a lot of money looking for less crowded trades, an environment where having that additional income orientation and not just the growth side brings that quality aspect into things. I almost think of, and we do a lot of work on factors, and
Mhm.
often we'll say you want a blending of both growth factors. You don't want to give up that growth measured via the factor lens with, forward earnings expectations,
Right.
positive earnings surprises, but you want to bring that value component in too. So, I'm 40 years doing this. That's how long I've been on Wall Street, and I guess it was probably popularized for the most part in the 90s. That growth at a
Yeah.
reasonable price, which these days, when we talk from a factor perspective, it's sort of got that quality umbrella to it. And I think that's a really interesting area to be in, because you're not going to pure value where you sacrifice the growth part of the equation, but you also get that income generation without having to sacrifice growth opportunities by going into a safer area like treasuries, or at least a perceived safer area like treasuries.
Right. So maybe let's shift gears. It's fun talking about equities, of course, but maybe shifting a little bit to inflation and interest rates. Inflation today, as it typically does, has these competing forces.
Yep.
Right now, really energy prices, and you could argue some, from an AI perspective, some productivity-driven pressures that are pushing it down. What are some inflationary pressures, both positive and negative, that is on your radar that we want to be thinking about, currently and over the next, couple of years?
Yeah, so on the positive end, we had until very recently the downward pressure on oil prices, significant
Right.
downward pressure on oil prices, which served to the benefit of the recent CPI and PPI reports, at least at the headline level. Um, Maybe it's a poor pun, given Hormuz, but that ship has sailed, at least for now. We don't know what's going to happen. We don't know what's going to
Right.
happen between now
Right.
and an hour from now, in terms of announcements and narratives around the war. But you know, so we had that benefit to headline inflation. Under the surface, we still have some tailwinds in terms of the disinflation that finally started to kick in many of the shelter and housing components, like owner's
Hmm.
equivalent rent. Although we're probably not going to get much more downside from here, not likely to get a big shift to the upside. So that's relatively benign.
Yeah.
The problem is, from an AI perspective, the productivity benefit that suggests the AI will at some point be disinflationary, that's down the road. Problem right now is embedded in core measures are things like software and
Right.
technology equipment. And those measures of inflation
Yeah, import
are almost
inflation.
parabolic.
Right.
Import inflation, yeah.
Yeah.
So, and the problem is the AI build out, and I'm glad you mentioned that, because I've been getting a lot of questions about when we were seeing a downward set of revisions to second quarter GDP estimates, especially through nowcasts like the one that Atlanta Fed puts out, their
Right.
GDP now, which just tracks data as it's coming in. And I got a lot of questions saying, well, if we have this AI boom, why are we seeing, and you continue to see up estimates to what will be spent from a CapEx standpoint, we're seeing it in the business capital spending numbers within GDP. Why are overall GDP estimates coming down? And that's in large part because a big chunk of what is spent when building out AI and data centers and the infrastructure associated with it are imports. Well, the equation within GDP, given that we import more than we export, if there's more being spent on imports than there's money being earned in exports, that nets each other out. And if it's more on imports, it's a drag on GDP.
Right.
So that's one of those inner workings of these economic numbers that I find a lot of people, because they don't live, eat, and breathe this, they're not in the weeds of this stuff. And it's not specifically what we were talking about, but another one that I always want to educate people about is that a lot of economic data points are reported in nominal terms, not real
Mhm.
terms. So retail sales, we think of that as a proxy for consumer spending. When that's reported, that's a nominal number. If you spent, $50 to fill your car with gas in 1 month, and then the next month you spent 75, your consumer spending in nominal terms may have gone up by
Right.
50%, but you didn't get any more for it.
Right. You
It's
need
just
more
because
for
the
it.
price went
Yeah.
up. So
Yeah.
I think sometimes understanding how the sausage is made with these numbers is important.
Yeah. Well, certainly don't envy the Fed in this environment. And obviously, we have a new Fed chairman. So,
Yep.
I have to ask just in terms of, if you had the opportunity to give Chairman Warsh some advice, what would it be given, all that we're talking about and expect from an inflationary perspective?
Well, one caveat, I've known Kevin Warsh since 2003.
Yeah.
That said, we're not in a daily text exchange with each
Yeah.
other, and he's taking my advice. So
Right.
I would say be really methodical about the direction he appears to want to head, want to move toward around communication. And I don't necessarily disagree with the notion that maybe it's too much of a federal open mouth committee, that is there really the necessity of press conferences after every single meeting.
Yeah.
You could understand why at times it made sense to provide more transparency and provide more forward guidance. And I also understand the rationale for not doing that, because what you end up with a lot of forward guidance and the cacophony of speakers is you tend to have market reaction to what is being said. And even though
Right.
the background claim is data dependency, the data is there to guide the Fed, then their voices are what dictate market reaction. So
Right.
there is almost that middleman in there that may not need to be as vocal as it has been in the past. But I think he's going to have to do it somewhat methodically. And that's probably, I'm sure he knows that, hence the creation of these 5 task forces. But
Yeah.
we'll have to see. Next week is the meeting.
Yeah.
He has a press conference. He's going to get a ton of questions. I have a feeling the answers are either going to be shorter or in many cases non-answers,
Yeah.
TBD, like, okay, what's going on with the task
Yeah.
forces?
Yeah, I often think back of in the 90s where people would look at Greenspan's briefcase and try to determine, kind of what the
Yep.
next Fed policy initiative was
I
going to be.
remember it well. And by the
Yeah,
way, I asked him about it on stage at Schwab's Impact Conference
yeah,
when I interviewed him a number of years ago. And he said he loved that. He got a kick out of it. And
yeah.
sometimes his wife would just pack a thicker lunch to just see what the buzz was on
See what it was.
CNBC. Yeah.
No, that's great. So I have to ask, do you think the next policy shift is it going to be a rate hike or a rate cut?
I think it's a hike, but I don't think it's at the July meeting. As to whether it could be at the September meeting, I think that that's throwing a dart at this point,
Yeah,
because the data will dictate that. But I think they hold at the July meeting.
yeah. So I don't like delving too deep into the political theater, but investors often ask us, how much emphasis should we place on the election? And as we head into midterm elections, and of course the potential for a change in congressional leadership, are there any policy initiatives that you would kind of say, hey, this is a concern, something that might arise, or even something that could be positive? Is there anything on your radar from that perspective?
Obviously, it depends on what happens. I think if there were to be a blue wave, then you're going to get a tremendous amount of pontification on what it means from a policy standpoint, what can still be done, where the
Mhm.
control would still lie with the president via executive order, tariffs being an example of that, or where things could potentially get adjusted. by virtue of a change in control of one or both houses in Congress. I would also say that we're likely to see an increase in investigations, inclusive of how the war has been handled up until this point. It's hard
Yeah.
to pinpoint what that means in the short term for the stock market because the market's kind of been all over the place and isn't
Yeah.
always easy to kind of tie directly to geopolitics or politics or even economic data. The one thing I'd say more broadly is there's nothing that's more emotional these days than politics.
Right.
The how partisan things are and the vitriol and how ugly it's become.
Yeah.
Try to leave that at the proverbial door when it
Right.
comes to making investment decisions. In a backdrop of heightened emotions, if that gets applied to decision making in portfolios, I think that's where the problems start to arise. So
Yeah.
understand absolutely the emotions. I feel them too, but try to put blinders onto that when it comes to investment decision making.
Yeah. So shifting just real quick to an area that we focus on with our clients, and I'm sure you're seeing it, day to day, is that, many of our clients are actively participating or planning, kind of a generational wealth transfer. And, this is happening at a time when, markets feel faster, noisier, a lot of things that we're talking
Yeah.
about. And, I kind of think about it again, kind of in the 90s, where it seemed like fundamentals and valuations took a backseat to momentum and just the exuberance around the technology platforms. So with that in mind, what lessons or words of wisdom would you share with kind of that next generation or that younger investor, as they're thinking about investing and their influence currently, with the current market condition?
I couldn't love that question more. And the reason is because the part of the answer I'm going to give is we're on such a mission, particularly with a message to young people about the blurring of the lines that we're seeing between investing and gambling.
Yeah.
And it really is quite jarring. There was a recent Harris poll done of generations, starting with the oldest that they polled, the baby boomers. I'm part of the baby boom generation, all the way down to the youngest, adult generation. And it's still surprising that 50% of baby boomers said they did consider more speculative gambling like betting as a somewhat equivalent alternative or a way to think about wealth creation,
Right.
but it was more than 80% for the younger generation. And we know what
Wow.
we've seen with the blurring of the lines and how that whether it's the sports betting or other betting markets or the prediction markets,
Yeah.
there's sort of the get rich quick scheme and the ease of doing it, and the popularity of them. And I wrote a piece back in April that got a lot of attention. It was titled Gambler's Blues. It's still on schwab.com. Shameless
Right.
plug. I mean, it's
Yeah.
it's
No, I'll
three
have to
months
look at
old,
it.
but it really went into detail about the differential. And I would say the overarching message was investing is about owning. You are a participant. You're a participant in wealth creation, and the odds are with you
Right.
over any reasonable period of time. Gambling is about hoping, and you're not a participant, you are a spectator. You
Right.
step back from the gamble, you hope you're going to win a windfall. More likely than not, you're going to lose the entire investment.
Yeah.
And we want to at least be one of those voices that attempts to unblur those lines because investing is not about get in, get out, or get rich quick schemes. That's just gambling.
Right.
Investing is and should always be a disciplined process over time.
Yeah, we certainly share your sentiment, and we kind
I
of share
figured.
that with our
Yeah,
clients as well. So you've been very generous with your time. I would like to close with
my
just one
pleasure.
question as we think about it. I always like to look forward, and as I look at the next 5 years, what do you think investors, from your perspective, will realize that they spent far too much time worrying about today, versus its impact to them long term? What is that one thing that they're spending too much time worrying about?
Um, may seem like an odd one, but everybody that I talk to is extremely worried about the deficit and debt.
Hmm.
I'm not saying I'm not worried or that you
Right.
shouldn't worry about it, but they worry about it in the context of something imminent is going to happen.
Right.
The US is going to default on its debt, or the dollar is going to lose its reserve currency status, or a foreign creditor is going to dump treasuries all of a sudden. So I worry about it in a big picture sense, and I think everybody should be worried about, but I don't worry about some imminent calamity
Yeah.
driven by that.
Yeah, no, that makes sense. Well, again, Lizanne, thank you so much for your
My
time.
pleasure.
Yeah, I also want to thank our clients and our investment partners for their continued support and attention, and hope you and they have a great day and the rest of the balance of 2026. But thank you so much.
My pleasure. Thanks for having me.
Uh-huh.